Earnings season is coming to a close. Let's talk about the outlook for the rest of the year and into next year. Recession? No recession? Let's take a look at it. Welcome back, everybody. Don Miller here on the channel to give you a little update of what's going on in the market, what we look forward to as a preview. This week, we're going to change things up just a little bit. We're going to talk more about an outlook for the rest of the year and into next year and next summer. Thomas won't be joining us today. He is out on vacation, enjoying the beaches of North Carolina at last check, but he'll be back next week and we'll get back to what we were doing. We wanted to talk about the outlook for the market. The S&P is up almost 20% for the year. That's good news. Everybody's excited about that, including me. My 401k looks a lot better this year so far than it did last year. But we're going to talk about what we think may happen, what we're seeing in the way of data that points to what's going to happen for the rest of the year. We got another earnings season. It's just about complete. According to FactSet, 84% of the S&P 500 companies are in. Their results are in, with about 80% of those surpassing expectations or Wall Street expectations. That's good news. And at first blush, that sounds like really good news. But remember, these are lowered expectations. This is not the kind of expectations that we had earlier. The earlier part of this year is when expectations began to be lowered. So they are lowered expectations, but the good news is they're still making money. Companies are still making money. At least 80% of them are anyway. And that's good news. But just consider this, with those lowered expectations, and we've talked about this on the channel many, many times, there's a new normal being implemented as we speak. It's not scaring off the investors or retail investors this summer. So just keep in mind, expectations were lowered. It's making it a lot easier for company to hit those marks. I think this year, or so far this year, the market has done well. We've got a melt up this summer. The fear of a recession, if you will, has been kind of pushed off into next summer, kicked down the road, but the odds are still high that one's coming in. That's what we want to talk about today. That's what I want to talk about. The Fed raises rates like they do, and it takes a year or so, by their own admission, for those rates to kind of take effect. So anything that we did in April as far as a rate hike is next April before we really starts to grab and make things change. And with that, consumers' spending habits change, spurred by that high inflation and the rising interest rates. And we think that's going to continue to weigh on the outlook. Another sign of a looming recession is the yield curve and the index of leading indicators. Index of economic indicators, if you will. The yield curve hasn't been wrong since 1955. It's a classic recession indicator, and earlier this summer, it hit its deepest level in over 40 years. I'll leave a link in the description down below where you can read about that, and that article is very interesting. And you can make the argument that things are different this time. But I think that's a pretty big assumption to make at this point. So we're just going to have to wait and see. But there's many people out there, including some of our own staff, that think we're in a recession right now. The administration and the smart people have kicked back on that, pushed back on that a little bit, saying that we're not in a recession. For many people watching this video, I'm going to tell you that it feels like we're in a recession. And like I said, we have some mixed points of view on that, even amongst our MarketBeat staff. The leading index, the index of leading indicators seems to agree. The index has been negative for 15 months and is trending even lower. Nothing about that suggests economic strength by any means, despite the fact that Q2 GDP was revised higher. These little blips of information that come in, they're important. The Fed looks at them, analysts look at them, but you've got to take a wider look at what's really going on. The outlook for Q3 in the second half is much different. Analysts expect a sharp deceleration of 1% or less, with less being more likely what we get. Heading into the fall, it's likely that you can expect a few more smaller banks to fail. The tightened conditions already caused 3 banks to fail, and more can be on the horizon. The FOMC has hiked rates twice since those failures and is on track for another. So the odds of another 1 or 2 or 3 small banks failing also puts pressure on the economy and the market and what's going on. Treasury Secretary Janet Yellen plainly said, expect more consolidation within the financial industry. Okay, let me stop here for a minute. Consolidation is code for bank failures, okay? But yeah, consolidation sounds better. But the fact is, Yellen is calling for more consolidation among the banks, which means more failures, more pressure on the market. And so we're going to be looking out for that this summer, this fall. I think that everybody should just pay attention, because things are happening behind the headlines sometimes that that really catch you by surprise. Inflation data is promising, and I want to say that again, amongst our MarketBeat staff, there's some discussion about whether or not that's a good sign, whether or not inflation will continue to cool, whether or not we beat it back. Again, we put a poll on our MarketBeat YouTube channel that asked our readers, or viewers, I should say, what they think about inflation as the Fed beat it back. Obviously the Fed helped create it in our view, but did the Fed beat it back? Are they winning the battle? Is it that soft landing that they like to talk about? Is that a realistic expectation? But we don't think the Fed is finished hiking rates by any means, but I'll talk about more about that in just a minute. More good news came out today. Job numbers were reported and was cooler. The market rallied. Investors got excited about that, and that should be a good sign, right? But again, taking a broader look at things, looking down below the headline number, average hourly wages pointed towards more inflation and came in ahead of expectations. That's something you need to pay attention to, because when that job number gets out of sync and the wages increase like they are, the Fed's going to act. They have to do something, and they will. And so they're calling for 1 more rate hike this fall. I believe October is the general consensus, but there could be more. The next FOMC meeting is in late September, so there'll be several readings of CPI and PCE between there and now, or then and now. So just keep that in mind, that we still have inflation. Best case scenario at this point would be for inflation to kind of level off, maybe go sideways for a month or 2 or 3 or even more. Even better, go down. I'd love to see it go down, as everybody would. But there's something on the horizon that I want to talk about. It's not the first time we've talked about this on this channel, and that's the price of oil. Oil price drives inflation because it underpins the cost of everything. When the price of oil goes up, it has a compounding impact on inflation. And OPEC has purposed itself to raise prices, and that could lead to a reacceleration of inflation, and that's not out of the question. Last week I paid $3.29 per gallon to fill up the old Pathfinder. This week I paid $3.89. So something's going on there. Last week on our video, we provided and showed you guys a chart to show the correlation between oil price and inflation. Keep in mind, they ride on parallel tracks. If oil prices go up, so is inflation. And again, the talk of recession will start to get more prevalent. So keep an eye on that. The Fed will act. I promise you, they're not. They feel like at this point it looks like they're getting a handle on things. Maybe that soft landing is possible. They're not going to let it get away from them again. So just keep an eye on oil. It's going to have a big factor. It's going to be a big factor going towards the end of this year and into next year. So where do we go from here? The S&P is melting up because of the recession being kicked down the road. We mentioned that earlier. It's our view amongst the staff that we've talked about. Investors want to be happy again. They want to invest again. They want to feel safe. They want to party like it was pre-2020, if you will. Everybody wants everything to go up again. I know my 401k personally is doing a lot better this year than it was last year. I think the S&P is up nearly 20%. Now ask yourself, can it continue at that pace? Well, of course it can, but it's facing significant headwinds. Recession being among those headwinds, but oil prices are important. I'm going to say that one more time to drive the point home. Keep your eye on oil prices. It could be one of the biggest factors in getting inflation under control or losing control of it again. Either way, the market rally is on shaky footing right now in our view, and you have to assume the big money traders and investors who were positioned for a potential recession this year will be again next year. What we'd like to know is what you think. If you would, leave a comment down below. What do you think the market's going to do? We asked on our channel several times, excuse me, on poll questions, whether or not inflation is getting better, or do we expect it to get better as the Fed won that battle? I know some of you are going to say, well, the Fed created it, well, they probably did, or they had a part in it. But do you think that they're turning the corner on getting inflation under control? We want to know what you think. I don't want to know what I think or what Thomas thinks. We want to know what you think. So leave us a comment down below if you would. If this video has been any help to you, we'd appreciate you liking it. That does good things for our channel on YouTube. If you haven't already, we'd consider subscribing to the channel. We'd appreciate that. But until next week, I'll have Thomas back. We'll see you then.